In October, October 2nd and 3rd, will be the Indiana Summit. And as the video previously shown, it's going to be held in Muncie, Indiana. Muncie is really rolling out the red carpet for us. You heard the mayor. I went there 10 years ago, and it is not the Muncie of today. It's been redeveloped downtown. The great sense of pride for that town, and it looks fantastic. The convention center since then has added the Courtyard Marriott actually attached to it. It had everything we were looking for in terms of a venue. Free, easy parking, both covered and non-covered. The convention center is located downtown, walking distance from all restaurants and bars and visiting museums and galleries and everything that Muncie has to offer. And they really are treating us very well. As you know, we've gotten great access in working with them, working with the mayor. Planning is still going on, but I think it's going to be a very special event. So if you guys can get it on your schedule, sign up. And again, you can sign up online at NAIFA Indiana, NAIFA-Indiana.com. So at that event, I'd also like to extend actually all of NAIFA Indiana board, their congratulations to Greg Boyer, who's the 2020 Jack Peckinpah Advisor of the Year, receiving that award. Looking forward to that first night and being able to celebrate that wonderful award the first night at the summit. With that, let me move on. What we're going to be talking about this morning is the state of the long-term care insurance market in Indiana. We have actually a local that's an expert in the long-term care market, Chris Barnhouse, who's going to lead this discussion this morning. I have his bio here. Let me read it for you. Chris Barnhouse served more than 25 years in the United States Army before embarking on a career representing the Northwestern Mutual Financial Network and other select companies in 1997. Although he served primarily in the infantry and special forces, Chris became most known to Indiana as the Army's spokesman during the final years of Fort Harrison. Since his retirement, Chris has become a recognized expert in the field of long-term care insurance and is often asked to speak on the topic at public and industry forums. His 2011 testimony before the Indiana General Assembly is largely credited with gaining nearly unanimous support for a bill that lifted restrictions on the long-term care insurance industry that had severely retarded sales in Indiana. In addition, his business activities, Chris stays busy with his volunteer work as president of Lawrence Kiwanis Club, advisor to K-Kids at Harrison Hills Elementary School, and as an active member of various veterans service organizations, including the Military Officers Association of America, the Association of the United States Army, AMVETS, and Vietnam Veterans of America. A member of NAIFA since 1998, Chris served on the board of directors for NAIFA Indianapolis for nearly 15 years and as its president during the 2015-16 year. He currently serves on the NAIFA Indiana Government Affairs Committee. Chris has a Bachelor of Science degree in Biology and Chemistry from Nichols State University in Louisiana and an MBA from the University of Indianapolis. He lives in Carmel with his wife of 30 plus years, Lisa. In this session, he will discuss the current state of the long-term care industry in Indiana, and there's really no one that I know of that better qualified to do so. So with that, bring on Chris. Thank you.
And now from Indianapolis, almost live, it's the state of the long-term care insurance market in Indiana. This is a NAIFA presentation. It is sponsored by Mass Mutual. Joe and Mass Mutual provided the coffee and donuts for you that aren't here. You don't get to have any. We're looking forward to talking to you about many of the changes that have occurred in the long-term care insurance market over the last couple of years, particularly this year, and a little bit about what our response to it should be. This is good for 1 hour of long-term care insurance, life and health CE. You do have to check in occasionally to let us know that you get credit. So for those of you that are online right now, just type in "I'm here" on your chat feature. For those of you who are sitting in the room with me, you don't have to do that. You can just wave to me and say, "Hi, I'm here." Objectives for today: we want to view the available public and private options for long-term care, explore industry trends and diversification of long-term care insurance, and exchange ideas. This is the interactive part. That's where we have the chat feature. Exchange ideas and best practices in helping Hoosiers address their long-term care risk. Not that we don't care about Buckeyes and whatever, and the Fighting Illini, but we're really focusing on Hoosiers here since we are NAIFA, Indiana. If we're going to talk about long-term care insurance, however, the first thing we have to do is identify what long-term care is. So this is your first interactive option. Go ahead and type in on your chat feature what you think long-term care is. And I'll ask questions. Those of you sitting with me, what is long-term care? Somebody give me a definition. Sheila, come on, you know what long-term care is.
It's the provision of skilled assistance as directed by a medical professional for cognitive or physical. This is where I'm going to screw it up. Chronic.
You got the right word, chronic, yeah.
As opposed to acute that can be fixed.
Okay, yes. And that's close. Andy, did anybody type anything in?
Someone just asked, what is long-term care?
She asked what it is long-term care. Well, if you don't know, you're about to find out. I expected somebody from South Central to type in because I just taught a 5-hour renewal CE on there. And this was one of the things I taught. So anyway, what is long-term care? Lisa or Sheila, you're really close. Except it doesn't have to be director.
Oh, I have another.
Okay.
They say it's care needed for old people, custodial care.
It can be, but it's not necessarily for old people. 40% of the people in long-term care situations are under the age of 65. We generally think of it as an old person issue, but it isn't necessary. I have a very good friend who entered a long-term care situation in his 50s because he had a biking accident and suffered a brain injury. I had an assistant who had to take a year off because her husband suffered a brain injury in his 50s. So it is not entirely uncommon for someone under the age of 65 to need long-term care. But one thing Sheila said, it is the operant term is chronic illnesses, is debilitating chronic illnesses. Now, since we talked a little bit about chronic illnesses, what are your chances of needing long-term care? How many people here think they're going to need long-term care before they die? Okay. I got all the hands raised here. These are the people that I'm exposed to the market. Usually when I speak to a group, nobody raises their hand. But we'll talk about it. How many of you sell property and casualty insurance? Yeah. You can sell car insurance, auto insurance. A lot of your State Farm, I know we got a lot of State Farm viewers out there. Auto insurance. This is what your client's chances of having a major auto accident are. 3 in 900.
What's the time period, Chris? In 1 year or
forever? Okay. This is what your chances, your clients have a chance of having a major residential fire. 7 in 900. That's forever. Remember, every time there's a residential fire, it's on TV. It's because they're not that common. Okay. Any of you have clients that have health insurance? Or do you have health insurance? You all have to have health insurance. Sure. It's the law. You're required to. Okay. This is your client's chances of entering a critical care unit. Now, back when I was an EMT, we called it intensive care. They changed the name to critical care because everybody just started calling it expensive care. But this is their chances of needing expensive care, critical care. This, on the other hand, is their chance of needing long-term care. 630 in 900. It's, if you have a couple, it's a statistical certainty that one of them is going to need it. And yet we're still not reaching them. But why? Because people wish it away, or they think somebody else is going to take care of it. One of the things they think of is government programs. The two major government programs are Medicare and PPACA. The Patient Protection and Unaffordable Care Act, also known as PPCACA. That's a slight editorial comment. Were you aware that PPACA had a long-term care element? at one time. It was called the Class Act. Anybody remember what? I used to teach a CE on this. Anybody remember what the Class Act was, what the class stood for? Here, I'll give you a hint. Community Living Assistance Support Services. And what that was, it was going to be a voluntary program that everybody could sign up for. They were going to encourage people to sign up for it because there would be penalties if you didn't sign up for it right away. The benefits were incredibly generous. It was for home health care only. But when everybody looked at how it was going to be administered, the entire industry told the people that designed it, you're going to have to charge $400 a month to everybody for the premium here. And they said, oh no, we'll be able to do it for less than $100. And I said, you're going to have a hard time convincing an 18-year-old with his first job to pay $100, let alone $400. And they went through the process. They looked at it. After it was passed into law, and to give you an idea how incompetent government is when dealing with long-term care, before the Class Act was in the bill, the original Senate bill had the addition of long-term care insurance to cafeteria plans, Section 125 plans, and they pulled that in favor of the Class Act. Having it in Section 125 plans would have caused an explosion in enrollment to private insurance, but the government doesn't control that, so they wanted to have something they could control. Kathleen Sebelius, with the Director of Health and Human Services at the time, the Secretary of Health and Human Services, she missed every deadline for designing the product. And then the Joint Deficit Reduction Commission met and they put out the report. The first line in the report, the first recommendation they had was repeal the Class Act. And so it was the only portion of PPACA that was repealed. It was quietly repealed a year later unanimously. Why do we go through this? Because that lets you know your government is not going to come to your rescue. They have already indicated they can't do it. Even when they try to do it, they can't do it. So forget about that. Medicare, how many of you think Medicare covers long-term care? I can't see your hands. You can raise your hand if you have a raise your hand feature there. Raise your hand. Sheila's giving me this. Yeah, Medicare will cover a tiny bit. It's the transition from acute to chronic, because Medicare covers acute illnesses, not chronic illnesses. The way Medicare works is you have an incident, starts at home. Maybe it's a broken hip, heart attack, whatever. You start at home, you go to the hospital. The hospital gets paid based on what are called diagnostic-related groups. That means they basically get paid for a heart attack, a broken hip, a whatever. That also means that the day you check in to the hospital, that's as much money as the hospital is going to make. So what they do is they move you out as quickly as they can. In the industry, we call that moving out quicker and sicker. They just stabilize you and move you off to skilled care, which looks like a hospital, smells like a hospital. There's just not a doctor there all the time. And a lot of the hospitals will have a skilled care unit so they can capture more of those Medicare dollars. If you're in skilled care, Medicare will pay if 3 criteria are met. First, you had to have a 3 overnight stay in the hospital. You had to stay 3 overnights. Now be careful, because it has to be 3 overnights for treatment. What a lot of hospitals are now are checking people in for observation. And you got to tell your clients to get up in the hospital's face and say, no, he's there for treatment, because those days don't count. Observation days don't count. I'm not sure exactly what it is. There's some sort of financial incentive for the hospitals to list it as observation instead of treatment. So it has to be for 3 days of treatment. They have to be a skilled care facility. It cannot be any other level of care. So 3 overnights, skilled care, and they have to be getting better. That getting better may involve, they just go to rehab. I've seen it where Medicare would continue to pay. Somebody was not going to get better, but they wheeled them down to rehab for a half hour a day and wheeled them back to the room, and Medicare continued to pay. Or there may be certain performance measures they have to meet. But Medicare is pretty strict. But if all 3 criteria are met, 3 overnights in a hospital, in skilled care, and getting better, Medicare will pay for the 1st through the 20th day based on diagnostic-related groups, just like they paid the hospital. From the 21st through the 100th day, there's a copay. And as of this year, that copay is $170.50 a day. That's what the patient is responsible for. Now, if they have a Medicare supplement level E or higher, that will take care of that supplement. But if they don't have that, that is all out of pocket. After the 101st day, Medicare doesn't care how much better you're getting, how much time you spent in the hospital. You are now chronic. And Medicare does not pay for chronic illnesses. So you might infer Medicare will pay for the first 100 days. They can. I've seen them pay for 100 days. I've also seen them pay 0 days. On average, Medicare pays less than 30 days. Why? Because something happens in the first 30 days. They either quit getting better, they go home, or go to a different level of care. And when they go home, that's a completely different issue, and we'll talk about that. They have a whole different set of criteria. Medicare problems, acute illness only. What did we say the operant term for long-term care was? Chronic. They don't cover chronic, they cover acute. So as long as you're acute, they cover it. Same thing with health insurance. Health insurance will cover acute, but not chronic. So most of your health insurance policies are structured the same way Medicare is. If somebody has health insurance, it'll cover them about what, maybe even less than Medicare does. And then they'll have to pay out of pocket for the long-term care. There's also funding. Anybody read the Social Security Trust Funds report this year? Anybody remember when Medicare runs out of money? Well, they're actually spending more than they're bringing in for Social Security. They actually run out of money in 2026. Medicare runs out of money in 2026. So we're 7 years away from running out of money. They're going to fix it? Yeah, because old people vote in blocks. And what matters in politics is money and votes, and we have the money and the votes. I say we, I'm 67 years old, so, look out for me. But yeah, they're funding. Why do I bring up funding? How are they going to expend? They've got all sorts of candidates, presidential candidates out there talking Medicare for all. It's only going to cost $31 trillion extra dollars. We can afford it because according to the U.S. debt clock, we only have 124 trillion in unfunded liabilities, which is another 31. But Medicare, if they're going to run out of money, how are they going to add new programs? The money is not there. Home care. Medicare does not cover home care. They cover it to a small degree. For home care, the rules completely change. If you're on Medicare and you are at home, Medicare will pay for professional care. There's 2 types of care at home. There's personal care, which means helping you with your activities of daily living, eating, bathing, dressing, that sort of thing. And professional care involves a skilled therapist. Medicare will pay for a skilled therapist if it is recuperative in nature. For example, somebody has a stroke, loses the use of both limbs on one side of the body, never going to regain the use of those limbs, but they also lost their language, will regain the language with speech therapy. Medicare will pay for a speech therapist to go in and work with them because that's recuperative. But if they bring in a physical therapist, occupational therapist, massage therapist, whatever, to manipulate the limbs to make them feel better, Medicare will not pay for that. That's not recuperative. That's custodial, maintaining the same condition. The bulk of care at home is personal. There was a study a few years that found that the value of the personal care being provided by family members to disabled elderly people was valued at actually had a value greater than the entire Medicare budget. So there are lots and lots of people doing home care for people, and it's destroying. There's now actually Medicare has a code for a disease called caregiver stress. Because somebody's trying to give care. Often when people say, well, my wife will take care of me, it's always the wife. Wife never says my husband will take care of me because they know better. Husband always says my wife will take care of me. My response is always, who's your backup? Because your wife will now die before you do. Statistically, the caregiver will die before the person receiving care because they work themselves to death. There's another issue about Medicare. Somebody read that. I know you can't read this part because it's hard to read, but this is actually off a Social Security statement. So, gentlemen here, would you just read this statement at the bottom there?
Medicare does not pay for long-term care, so you may want to consider options for private insurance.
That's on your Social Security statement. The government is giving a plug for our industry on the Social Security statement. Why are they doing that? Because they ain't going to do it. They're trying to give everybody a heads up. This is one of the ways I get to people. A good method is to call somebody up and they say, oh yeah, I've already got an advisor. They may or they may not. They're just blowing you off. Has your advisor gone over your Social Security statement with you? Yes, he has. I don't mean page 2 and page 3 where the numbers are. Has he gone over page 1 and page 4 where the warnings are? What warnings? Okay, well, let's have a separate conversation. And then I used to ask it differently. Now I show them this and I say, what has your advisor told you about this? I used to say, have you talked to your advisor about this? And they'd always lie and say, oh yeah, I have. They'd never seen it before. What has your advisor discussed with you about this? Maybe you should discuss this with somebody because it's on your Social Security statement. They're giving you a warning. This is what the cost of home health care is. This is off the 2018 Mutual of Omaha Cost of Care Survey. Home health care in Indiana is just a little bit less than the rest of the country, but you'll see our nursing care is higher. And it varies widely geographically, particularly for home health care. The more urban you get, the lower the home health care costs are. The more rural you get, the higher the home health care costs are because there are fewer people doing it and they have to travel distances. But this is actually a pretty good figure. So you can see $52,000 per year for home health care on average. You know, what kind of a hole will that drive in your retirement budget? And this is where claims are being paid. This is actually fairly old. It's about 5 years old. The companies I talk to now, it's up. They're paying about 80% of their claims for home and community-based services. It's not 70%, it's 80% because the trend in care is away from facilities. It's more toward home. There's a lot of technology that's coming online to allow people to stay home longer and longer and longer. The unfortunate thing is the only people that get to do that are people who can afford it. And we'll talk about this future. We're going to be going into Medicaid too, but in Indiana, your choice is if you're on Medicaid for care, or you can go to a nursing home, or you can go to a nursing home, or you can go to a nursing home. Those are your three choices. They don't pay for assisted living. They pay very limited amounts for home health care. Medicare, next is Medicaid. That's the most popular option, not because everybody likes it, it's because that's what people end up on. One of the reasons people go about 70% nationwide, 67% in Indiana of nursing home patients are on Medicaid is because they impoverish themselves while they're in care. According to the Department of Health and Human Services in Indianapolis, the average family is indigent for Medicaid purposes within a year of entering a long-term care situation. So how many of you have had people say, I'll just go on Medicaid? You know, I've got two responses to that. One first response is, why choose such an expensive plan? And then they look at me and say, what do you mean it's free? And I said, no, long-term care insurance is expensive. Medicaid will cost you everything you own. And I explained that to them. Then they will say, and then I might also say, so let me understand this. You want to go on Medicaid, so your long-term financial goal is to become an indigent ward of the state. Because that's what Medicaid is. I actually had one woman say, yeah, that's what I want. I said, go have fun. It won't take long. Yeah. So most people don't want that. What about Medicaid? Medicaid is a state entitlement program. It's welfare. It's not for people who just don't want to pay for their long-term care. It used to be that way, but they've gotten very restrictive. Deficit Reduction Act tightened things up a lot further. People don't understand that. It's for people who don't have money and they don't have income. And both spouses have to be impoverished. You can't have one have money and one doesn't. Everybody has to be impoverished. I think for an individual, I just looked at the numbers. The numbers are available on the website, on the Department of Insurance website. I think that the limit of income for an individual is $1,000. For a couple, it's $1,500 to go on Medicaid. And then if you got one spouse in care, and the other spouse isn't, the spouse that isn't gets to keep one house if he or she can live in one car, if he or she can drive it. And up to around $3,000 in income, $2,500 if they have it, up to $3,000 in income if they can justify it. Other than that, it all has to go toward Medicaid to cover the cost of care. So most people don't. And also limits your choices. You don't get to choose. I've had people say, oh, there's a really nice facility down the street that has Medicaid beds. It's a really nice facility. Guess who those Medicaid beds are reserved for? The people that ran out of money while they were in that facility. They don't just for anybody checks in. It used to be when you went to a nursing home, they couldn't ask many questions about your finances. Now they can ask everything. And if you can pay for your own bed, that you can go in. If you're on Medicaid, oh, we're all full up. And there's a reason for that. It was a case decided in Indianapolis about 15 years ago, I think almost 20 years ago now, that found that if a facility accepted a Medicaid patient, they could not make them leave. They have to stay. So they don't take everybody. What I find is I've had people that bought a small long-term care insurance policy because they knew it was the entry fee to quality long-term care, because they got in, they're paying for it. After a year, if they run out of money, that facility will keep them. For example, if you are in a hospital and you're a Medicaid patient, the discharge supervisor's job is to put you in the first nursing home bed available within a 25-mile radius of the hospital. So if your family lives 25 miles east of the hospital and they put you in a nursing home bed 25 miles west of the hospital, your family just got a 100-mile round trip to come visit you. And anybody who's been to a Medicaid facility will tell you there's a direct proportion between the quality of your care and the number of family visits you have. Because Medicaid only pays about 2/3 of what it costs for care. So guess what? In a Medicaid facility, you only get about 2/3 of the care. And again, Medicaid has talked for years about experimenting with paying for long-term care and assisted living, and they have never done it. They have never implemented that. Every year they talk about it, and every year it doesn't happen. So your choices are nursing home, or nursing home. You don't get assisted living, and you might get some home health care, but probably not. Most of the Medicaid waivers go to disabled young adults. What are the problems? You got to be indigent. Who wants to die poor? You have to impoverish your spouse. We talked a little bit about that. The spouse cannot have a lot of money if you're in care. This is the new thing. A lot of people think that they're still Medicaid. There are people who put out, careful when you talk to an elder law attorney. I've talked to a number of elder law attorneys. And what the top ones tell me is these are the two initials to look for on their card. NAELA, National Association of Elder Law Attorneys, and CELA, Certified Elder Law Attorney. Those are actually designations for people who actually do long-term and senior planning. There are a lot of people that put out their shingle as elder law attorneys who are just Medicaid attorneys. They can get anybody on Medicaid, and they probably can, except for one thing. The Deficit Reduction Act law of 2005 requires the state to go back and try to recover the assets when somebody who was on Medicaid dies. So one of the tricks for protecting your assets against Medicaid will put all your money into rental farmland. And put all your money in rental farmland. Great, you had $500,000, you bought some farm property, you rent it out, and that's protected, except now you died. Now the state is required to go back and tell you to sell that property and give the money to the state. You only got to keep the money while you were alive. Wouldn't it have been a whole lot more comfortable for you to just pay that money to a long-term care facility and get better care? And the state is getting very, very tough about this. NAFA had to actually go in and have a law passed because the state got so crazy about this asset recovery and spousal impoverishment that when a person, and we'll talk about the Indiana Long-Term Care Insurance Program shortly, but a couple had total asset protection policies under the Indiana Long-Term Care Insurance Program. One of them used up his benefits, tried to go on Medicaid, and some bureaucrat at the state said, no, both have to. Now the spouse's property is still subject. And we had to actually have the law passed that said asset protection is considered asset protection for both spouses. Now it's state law, but that's how tough they're getting. So don't think because you can play fast and loose with the code and hide some money for a while, it's protected forever. The state has to come back and get it. The other thing is filial responsibility. That's a term that only came up again a few years ago. Indiana is a filial responsibility state. There are about 30 of them. There are more than 30, I think 35. It's an Old English common law. And what it says is the government will come to your aid, but only if your family members don't. Under the law, family members can be compelled to pay for the long-term care or other debts for the indigent. What that came up with in Pennsylvania was somebody was in a nursing home. They thought they were going to be on Medicaid. Medicaid didn't pay. Well, under the law, the nursing home not allowed to throw them out. Now they're not getting paid. State won't pay them. The person's indigent, they can't pay them. They still have to provide the care. What are they going to do? So they invoked that law, sued the family members under the filial responsibility, and won. Anybody know the difference between case law and statute law? What is statute law? Somebody type in an answer. Yeah, it's law. It's law passed by General Assembly, some legislative body. Case law is decided in court. Which takes precedence? Case law trumps statute law because that interprets statute law. Once this was decided, it now is a precedent in all filial responsibility states. Indiana is one of them. I took this down to the General Assembly. I talked to my representative, Jerry Torr, who's House Majority Whip, who was also on the insurance committee, and he was very interested, but he said, you know, it's really a Ways and Means Committee issue, so we passed it over to the Ways and Means Committee where it died. So it is still on the books in Indiana. And where it will come up is when people apply or go into a nursing home assuming Medicaid is going to pay for them and Medicaid doesn't pay. And that's going to happen a lot. And so the nursing homes will have no choice but to sue under filial responsibility. So for your clients that say, well, I'm just going to go on Medicaid, are you familiar with filial responsibility? Are you aware that your family members, not necessarily the kids, could be brother, sister, aunt, uncle, whatever, can be compelled to pay your bills? Is that what you want? Indiana Long-Term Care Insurance Program. Indiana Long-Term Care Insurance Program, we've all heard the term partnership. It's a generic term for some incentives provided by the state to get long-term care insurance. Indiana was one of the original 4 states, and they actually did it a lot better than everybody else initially. And we'll talk about why it's not working so well now. I just want to do a quick review of the Indiana Long-Term Care Insurance Program for those of you who haven't seen it for a while. This is your average retired couple on the way to the opera or a pig roast or whatever. They all get dressed up, you know. During their lives, they've accumulated resources. It may be cash, real estate, home, business, 401k, IRA. It's what they've accumulated to live through their golden years with. There is a huge looming threat, and that is the threat of long-term care. Now, when I developed this presentation a long time ago, I still use it. My kids thought it was a video game. And they say, Daddy, let's play the dragon game. And I'd get out and play it. Now, for those of you, I look at the room, we got a lot of silver hairs in here because I know you guys don't play video games, right? But your children and grandchildren do, right? In these video games, if you have to fight a dragon, what do you have to do? There's always a magic sword or a magic bullet you have to go find. Guess what? Ain't one. We don't have a magic sword or a bullet. You cannot kill that beast. And it will breathe fire and burn down that stack of capital in no time. How long did I say the Department of Health and Human Services said it takes before someone's impoverished? Less than a year, yeah. So it doesn't take long for it to burn it down. The only way to protect that stack of capital is to build a firewall. Now, Medicaid has a very low firewall for individuals. Individuals, you can keep $2,000 in assets to qualify for Medicaid. That's all. If you're married, you get to keep your house, one car if they can drive the car, and half the assets. It's around like $112,000 right now. You can get the information off the Department of Insurance website. But and that's all. And I've had people say we only have 100,000, so we're protected. And I said you weren't listening. You get half up to. I mean, not less than 35,000. So you're going to spend 35,000. You're going to spend down to 35,000. So the original Indiana Long-Term Care Insurance Program said dollar for dollar asset protection. That meant you got a policy. This has a certain design. It's approved by the state of Indiana. And exhaust the policy, the state will ignore assets equal to the amount of benefit you receive from the insurance company. So if you got a policy that paid out $50,000 and you used it all up, you can go on Medicaid when your assets total $52,000. Because you still get to keep the original $2,000, and you get to keep the $50,000. The more benefit you receive, the more assets you can protect. Till you get up to a certain level, that's $1,000. You get a policy that pays out a total of $390,035 as of this, and that's per individual, and that's not for a couple, per individual. This year, Exhaust the policy, you have total asset protection. That means you exhaust the policy. You get a letter from the insurance company says, we're not paying writing any more checks. You're out of money in your insurance policy. They also notified the state that you had a policy with total asset protection under the Indiana Long-Term Care Insurance Program. And the state now says you're on Medicaid. Now, saves you a lot of time. This is the only caveat here. Income falls out on the other side of the wall. So you still have to spend your income down to the impoverishment level, which for an individual is $52 a month. That's what you get to keep. Everything else has to go to pay for your long-term care. The only way to protect income is with unlimited benefits. Except, guess how many policies under the Indiana Long-Term Care Insurance Program have unlimited policies now? None. And very few nationwide. There are a few, but most of them are not there anymore. So that's kind of a problem. The other problem is, take a look at how much you have to get each year now. As of this year, it's 390,000. Next year will be 409,000. When I first started doing this in the early 2000s, late 90s, I could put a couple into a total asset protection policy for $3,000 or $4,000 a year. Now to get a couple into a total asset protection policy, you're looking at 12, 13, 14, 15,000 a year. If you can afford 15,000 a year for your long-term care insurance premium, you've got so much income, since income is not protected, you're never going to benefit from it. So that's one of the issues. That's why, and we'll take a look at some statistics in a minute. Over the last few years that we have gotten statistics, we didn't get any for last year, in 2016, 2017, literally 12 people per year bought total asset protection policies. And I'm pretty sure they didn't know what they were getting when they bought them. So that's been a problem. We've also had a shrinkage in the number of companies. This is what the Indiana Long-Term Care Insurance Program looked like at the beginning of the year. These were the 5 companies. This is what it looks like now. Genworth quit selling individual policies. I understand they are still doing enrollments in group policies, but they're not selling individual policies. So for most Hoosiers, Genworth is off the ticket. And by the end of the year, Mass Mutual will no longer be partnership. They have a new policy that's in the process of being approved. It'll be approved sometime in the fall, and that will not be partnership. So you have Bankers Life that doesn't take brokered business, Transamerica, and Thrivent, which is a very good company, but there's only one brokerage in the country you can go through, and they're kind of hard to work with. So you've had a shrinkage in the number of companies that are offering it. And take a look at the numbers here. These are the statistics on partnership policies sold. And they didn't publish any numbers for 2018, but I don't think they got any better because the costs have gone up. They require 5% compounding all the way up to 75. Over 75, it's simple, still 5%. So they got very, very pricey. And people started looking at they started fleeing to other policies that didn't provide asset protection, but that were affordable. So what do we have nationwide? We have DRA partnership. Deficit Reduction Act partner was allowed in 2005. Prior to 2005, only the first 4 partnership states could have partnership policies. The OBRA 2006 presented, or OBRA 1994 prevented them from adding them. Because, and Indiana should be proud, because I was there when they were designing DRA. And one of the models was Indiana, because we were selling so well back then. And we can go back, let's take a look at those numbers. See, look at those in 2004, 2005. We were knocking it out of the ballpark. So I said, we want to offer this to the rest of the country. But they made some changes to it, some tweaks to it. They made it simpler. Filing process for the companies is much simpler. There are no special design requirements. All I have to do is put a cover letter on their filing that says this is intended to comply with the Deficit Reduction Act. Inflation protection, they said, we want to make this affordable. So they said inflation protection under age 60 and under is compounding. State specifies how much compounding. Some states go down to 1%. Between 61 and 75, or 74 rather, it has to have some inflation protection. State gets to specify. And they're all over the place on that because they want to make it affordable. 75 and over, no inflation protection necessary. Now, if you're 75 applying for a long-term care insurance policy, good luck because it's really, really hard to get at that age. But still, they wanted to make it affordable. What you had to give up is total asset protection. They were only giving dollar for dollar asset disregard in these states. Not a really big problem for us because there are only about 12 people buying total asset protection policies anymore in Indiana. So it's not like we're losing a whole lot. These are now available in 42 states. What is also nice is there is reciprocity between those 42 states and most of the original 4, meaning on a dollar for dollar basis, you get a policy in Indiana with that's under the partnership, and you move to Florida, and let's just take a look at all these states. You move to any of these states that are in yellow, and they will recognize the asset disregard on a dollar for dollar basis. California is the one outlier, the original partnership state that still won't play with everybody, won't give reciprocity. I don't know why nobody moves to California when they retire. It's too expensive. And then Mississippi, where my son went to college, they're still saying, too modern for us. But most states have partnership, and there's reciprocity between them, and the policies in there are going great guns. Now, when I get to this point, I'm going to remind everybody we are going to have some major announcements, but stick around after the CE because we're going to have some major announcements concerning the summit that you're going to be interested in. So we are going to have major announcements on the Indiana Long-Term Care Insurance Program and on some training programs we have coming soon. This is not one of the major announcements, but it is part of it. The current state of the long-term care insurance market in Indiana.
Should you go ahead and ask them to type something in?
Oh, that's right, Andy. Somebody type in LTC is good, or LTCI is good. Just type that in so we know you're there. Thanks, Andy. Yeah, we have to type in it periodically to give you credit. So everybody type in on their chat feature, LTCI is good. Or anything you want. You can say the speaker sucks, whatever. Who cares? Whatever. But type something in so we know you're there and we get you credit. Currently, we're in consolidation. Now, how many of you were selling disability insurance in the 80s? Yeah. How many companies were doing disability insurance in the 80s? A bunch. How many are doing disability insurance now?
Not nearly as many.
Probably about 10, and about 5 of them control most of the market. Same thing happened with long-term care insurance. I had a couple things going on. You had a lot of stock companies that participated in were selling long-term care insurance. What they found was margins for long-term care insurance are really slim. So the stock companies got out. Wall Street does not like slim margins with a whole lot of risk. So what we had, and this is actually a few slides about 5 years old. I got it from the Society of Actuaries. No, they're not as boring as they sound. But you'll see that the top 5 companies sold more than 60% of the policies, and that's probably gone up since then. And the top 25 sold almost all the policies. So, and we expected that because companies made wrong assumptions. They got out. Just as a comparison, when I started in this business, these were the big dogs. I'm not even throwing in Genworth or GE Capital, but they were the big dog then, and now they're gone. But CNA, they quit selling. They've been trying to sell their long-term care insurance business for years. Nobody will buy it. Travelers sold to, I'm not sure whom, and then they quit selling. John Hancock was sold to Manulife of Canada, and then they quit selling. Conseco Senior Health actually went through bankruptcy, was taken over by the state of Pennsylvania and no longer sells. TIAA-CREF sold for a very short period of time, but then sold their business to MetLife, which then stopped selling. Hartford Life had a group policy for state employees under the Indiana Long-Term Care Insurance Program. They quit selling. Aegon had 3 companies that all quit selling, but then Transamerica came back. So you see, these are the top companies 20 years ago. None of them are left except Transamerica, and they had to leave and then come back. And you can see how it changes from year to year. We compare 2000 to 2010. These, see who the top players are in those. You see the top players in 2000, almost all of them are out of the business now. In 2010, most of those are out of the business. And then we take a look at the last couple of years, 2014 through 2016. And even the top player in 2000, nobody even knew Northwestern Mutual had a long-term care insurance policy. And then it became the top long-term care insurance policy in the country. Now they no longer sell in Indiana. And they temporarily suspended sales over a conflict with the insurance commissioner. So it's constantly changing. But the big thing to look at here, take a look at here. sales are down for traditional long-term care. Why do you think sales are down for traditional long-term care insurance?
Prices.
Prices went way up. A couple of things. Prices went way up on new business and on existing business. So people got scared. And take a look at the type of people that bought them. In 2000, this is Joe Average policy. You know, 42,000 was the average income when they bought it. And by 2010, that had doubled. Now, there were two reasons for that. One, the policies got more expensive. Also, what you see at the bottom, there were 35% employed in 2000. By 2010, it was 69%. Part of that is the marketing focus shifted. When I started doing this, my average client has always been age 52 at date of purchase. When I started 20 years ago, the industry was targeting retirees. The average sale was 67. And now it's about 55, 56. So they're closing in on me. But they're trying to sell to the pre-retiree because that's the time to do it. A, they're healthy enough, B, they can afford it. We take a look at the income is over 50,000 was for 42%, 77% by 2010. Total liquid assets stayed about the same. So it was really two things. It got expensive, and we changed the market focus. Problems with traditional long-term care insurance, it is very costly now. And we'll cover why the cost has gone up so much. Rising rates on existing policies. There are some really good reasons for why the rates went up. First off, they made some faulty assumptions. When they first started selling this stuff, their assumption was 10% lapses, just like DI. Guess what the lapses really are? They approach zero. They're less than 1%. You got to pry these policies out of some cold dead hands. They make them feel so comfortable. Secondly was they planned on paying 25% of the claim from the premium. The rest was going to come from interest they earned on the premium from the set-asides. Well, they had some very conservative estimates of 3 or 4% they're going to make. What have they been making for the last 10 years? 1 or 2, maybe. I mean, when it's a 0% interest rate environment for the last 10 years, unprecedented. So, and they said for every percent of interest they lose, they have to raise rates by 10% to stabilize the policy. So that's what a lot of the reason is. And we got strict underwriting. And I predicted that 20 years ago was going to get. Anybody been through underwriting a long-term care case lately? My gosh, you've almost got a sight in blood that you'll never use the policy in order to get one. And a lot of it has to do with they have a lot more information for underwriting. There are things 20 years ago that were absolute war stoppers that you couldn't get a policy on that they don't even blink at now. But things 20 years ago weren't even a problem that you can't get a policy for. So it has really changed. We're getting diversification. How many of you heard that long-term care is going to go away as a product? Long-term care insurance is going to end. I've heard it over and over. I had top people in the industry say, how long is long-term care insurance going to be around? It's going to stay around, but we're going to diversify. It's going to diversify. And it's going to diversify from traditional to hybrids, the hybrid life long-term care, and some specialty products. In the last few years, we have a number of specialty products that have come along to allow people who either couldn't afford or couldn't qualify for traditional long-term care insurance to get something. And something's better than nothing. Take a look at this. Between 2004 and 2014, life combo products went from 16,000 in sales to 94,000 policies sold, whereas traditional long-term care insurance dropped off. They've been splitting because as the traditional long-term care insurance policies got pricier and pricier, people started saying, well, I'm going to put this kind of money into something. I want to get something back. The hybrid products, the pros behind them, and hybrid, I mean, it's life annuity, life long-term care, annuity long-term care. A lot of them have a guaranteed return of premium. You put 100,000 in, if you ever want it back, you can have it back. The underwriting is a little bit easier. Also, if it guarantees somebody's going to get something, if you don't use it for long-term care, it goes to somebody as a death benefit. So a lot of people like that. Underwriting slightly easier, not a lot easier, but there are certain things you can get underwriting issues that you can resolve with a hybrid product that you can't with a traditional product. For example, I had a client who smoked 2 or 3 cigars a year, was diabetic. For traditional carriers, he's declined. tobacco use and diabetes. Went to a hybrid product because it was a light-based product, and they considered anybody who smoked less than 12 cigars a year a non-tobacco user. He was able to get the product. Be very happy with it. So it's not extremely easier, but there's some things you can work through. The cons, and there's something people don't realize. If you put 100,000 in, you got to leave it there. Now you can't have it back, or you can borrow it, but every time you take something out, you lose life insurance, you lose death benefit, and you lose long-term care benefit. So if you want to have the benefit, leave it in there. Most of the companies will just call this lazy money. If somebody's got something sitting at a CD or someplace where you just say it's my emergency money, it works. You're getting better return than the CD, and by the way, it covers your long-term care. And just remember, if use for long-term care does reduce the death benefit. There's some specialty products out there. There's short-term care insurance. It covers everything long-term care insurance does, except for a shorter period of time. You know, it might last for a year, but the underwriting is a lot easier and the price is a lot cheaper because they're covering a lot less. There's also specialty home care products that are, the underwriting is really easy for them. That I'll underwrite everybody right now. Are you in a nursing home now? No? Okay. Do you need assistance with your activities of daily living now? No? If you answer no to both questions, you are now approved. They don't cost much. They don't provide much of a benefit, but it is better than being out there alone, and it provides you money for care exactly where you want to receive it, at home. Okay. Now let's have everybody type in, I like home care. Put it in your chat feature so we know you're still there. I like home care. And then there's critical care insurance. It's kind of an outgrowth of the old cancer policies. It covers specific illnesses, and it's typically an indemnity product, pays a specific amount for specific illness. It does not cover the same thing as long-term care does, but it covers illnesses that cost 80% of the long-term care. So I call it the 80% solution. You can't qualify for traditional long-term care insurance, but you can qualify for this. The cost will be similar. You won't have the same coverage as you would long-term care, but you'll cover 80% of the things that cause long-term care. What's on the consumer's mind? This is what the consumers are thinking about over the last 20 years. Hey, look at this. Originally, they didn't believe insurers in 1990. Anybody seen long-term care insurance policy in the 1990s? They were all over the place. No wonder they didn't believe it. Yeah, but everyone had a different feature. So they had a hard time believing them. Now they pretty much believe them, except the disbelief has come up because they don't trust them because the prices keep going up after they bought the policy. Hard to choose a policy. They were very non-standard in 1990. They're now pretty standard now, so it's not hard to choose. But what's the number that keeps going up? Too costly. They're too pricey. And waiting for a better policy, nobody's waiting for a better policy now. They know they're not going to change that much. We've talked about the rate increases. People don't die. Therefore, they make the claim, and nobody lapses the policies, and the dropping in interest rates cause the premiums to keep going up. Why does underwriting tougher, and why does prices go up? Look at the data. In 2000, we only had 428,000 data points. By 2014, we had almost 7 million. The information is a lot more. So as we've gotten more information about who's making claims and how long the claims are, we're able to make better decisions, better pricing decisions, also better underwriting decisions. So how do we address consumers' concerns? You know, we used to charge a lot for long-term care insurance, and I was one leading the charge. You have to cover the worst case, which is nursing home care. You got to cover the full amount. Guess what we're finding out? On average, people are using only 67% of their benefits. Why? Because at home they're doing assisted living. So the consensus in the meetings I've been to now is design policies for the most likely outcome, which is assisted living and home health care, instead of the worst case. And take a look at the numbers here. This is a little bit dated, but this pretty much, it just raised it by about 25% and you're there for this year or so. 45 to 51, if it costs for an individual policy more than $100 a month, they're cause for concern. 52 to 58, more than 100 to 150, they're having trouble choking on it. And 59 to 65, if they could get the policy, between 150 and 200, they're choking on it. When we take a look at the hybrids, and we're missing some data here, but the light blue, the dark blue, that's how much they were that they were interested in a traditional plan. And as the price got higher, the numbers shifted to where they were far more interested in a hybrid product. So the higher the price goes, the more likely they are to choose a hybrid product. What's new? This is what's new. This is one of the major announcements. Keep your ears tuned in. NAIFA has been working with the Department of Insurance to reform the Indiana long-term care insurance program. We are very close to some decisions. We've gotten some concessions from them. They are willing to give up a lot of reports they don't need anymore from the companies. We're trying to get more companies to participate. They have made some concessions on interest rate, on the inflation protection for dollar for dollar asset protection. We would like that. We are trying to make the Indiana long-term care insurance program look just like the Deficit Reduction Act partnership program, except with some total asset protection for those 12 people a year that want to buy it. And we're very close to that. We've gone back and forth. We're getting industry responses, and we expect to do this. We're hoping to do it by regulation, but we also have the chair of the state insurance, the House Insurance Committee has said, yeah, if we can't get it administratively, they're willing to put legislation into it. So stay tuned. We've been working on this for 2 years, and we're getting, by the end of the year, we should have a solution on it. So stay tuned. The Indiana Long-Term Care Insurance Program is not dead. We expect to rejuvenate that in the next year. So stay tuned on that one.
Question, Craig?
Yes.
Would this apply only moving forward to new issues, or?
That's a good question. I meant to put, because I've had people say, well, what happens with people who've already had these policies? Grandfathered. Before we even started talking about making changes to the Indiana Long-Term Care Insurance Program, we confirmed that anybody who already has a partnership policy would be grandfathered into the protections they had under that
What if
policy.
it is a partnership now? Any possibility if the company is willing to?
Yeah, and this is people say, well, if they've already got a non-partnership policy and they've changed the program, can they get a partnership policy? Yes, if they reapply. It's an incentive to get people to purchase long-term care insurance. That's what the program was all about. If they already have a long-term care insurance policy, how much incentive do they need to get one? So yeah, no, they would not be able to exchange unless they apply for a whole new policy. But if they already have a policy, they're already grandfathered, whatever protections they had under that. So for this one, to make sure you're still getting credit for it, type in ILTCI, Indiana Long-Term Care Insurance, and then put a P on the end for program. What's the solution? Customize it. Ask the right questions. Match the recommendations to the client objective. Find out where they're going to live when they retire. The pricing might be different. Find out what their budget is. A perfect long-term care insurance policy that is unaffordable is not better than an imperfect long-term care insurance policy that is affordable. Make it affordable. This is the bottom line for all of us listening. The cost of long-term care is a looming fiscal disaster. We can't afford it. Suicide rate is the highest among white males over age 75. Bankruptcies are most common in people over 80. And it's from the cost of care. You have the solution. It is our responsibility to inform the public. Government's helping us to pull out that Social Security statement and say, read this here, read this. And you know where I live. Write this down. If you ever have any questions, I answer questions from all over the state. I don't charge you for it. I'm a freebie. I'm happy to answer any questions that you have. And now if everybody would sign in to show that you're still there, go onto the chat feature and say, great session or lousy section, or will somebody please wake me up? But don't log off. We got some other major announcements.
Oh, we have a question.
Oh, what's the question?
And make sure you repeat it because they can't hear anything
Right,
else.
right.
They can only hear you. This question comes from Greg Purvis. He asks, with State Life and Lincoln being the two largest providers of hybrid coverage in the nation, what input is the team working with the state getting from these companies?
That's from Greg Purvis.
Yes.
Greg, great question. Those are two of the companies we have reached out to,
State Life.
State Life and Lincoln. Lincoln is very much involved. We've been talking to Lincoln. They are on board. State Life has pretty much said they're interested and they will do pretty much whatever Lincoln says. They have not done partnership before, but when we approached them and talked about reforms to the Indiana Long-Term Care Insurance Program, we kind of got on the radar. So State Life is interested. Lincoln is very much involved in the reforms. So thanks for asking that question. Those are two of the companies we specifically reached out to. So everybody sign in. Now we go into major announcements. This is not part of the CE, but this is, we talked about the NAIFA Indiana Summit 2019. We talked about how many companies have dropped out of the Indiana Long-Term Care Insurance Program in Indiana in general. Remember, Genworth has withdrawn their product. Northwestern Mutual has suspended sales in Indiana. People are wondering where to go. So your professional organization, NAIFA, has turned the NAIFA Summit 2019 into a long-term care specialty meeting for part of it. For the breakfast on October 3rd, we have invited the top long-term care insurance brokers in the country to present and have booths. We have lined up a number of them. Mass Mutual will be there to talk about their new product, which they will begin brokering this fall. Newman Long-Term Care, which is the only company and a great company that you can get Thrivent through, as well as a number of other companies. They will be there to talk about Thrivent and the products they offer. We'll also have Golden Care that offers a number of traditional long-term care insurance and products, including Mutual of Omaha and Transamerica, but has a lot of those specialty products for people that can't afford traditional long-term care or cannot afford to pay for them. Along with Thrivent, for those Northwestern Mutual people out there, Steve Spurka, who was the vice president for long-term care at Northwestern Mutual, has now joined Thrivent, and he will be there at the meeting to talk to you guys out there. So, and we still have a couple of other companies we're talking to who may be there. Some would be very familiar names, but I don't want to divulge the names. They are all going to get 5 minutes to present during the breakfast, and then they will have a booth there so you can talk to them. So we've got four top ones out there, and expect to have some more. So please come to the summit. It is going to be a great place to learn about the long-term care and traditional long-term care insurance products that are still available in Indiana, and how, as well as the specialty products, and how you can use them within your practices. Also, yeah.
Is this in Muncie?
Yes.
Is it? Okay.
Okay.
CE with all that?
Oh, yeah, absolutely. Corden, you kidding? If you just go to NAIFA meetings, I generally renew my license with about 60 hours of CE just from going to NAIFA meetings. So also NAIFA, seeing the need for more information about long-term care and long-term care insurance, has established an online community that is free to anybody who wants to participate. Go to lecp.naifa.org, and it's a clearinghouse for ideas about long-term care and long-term care insurance. They have a lot of top experts you can contact directly. They have a blog, but NAIFA decided they needed to meet the need. They were actually attending the same conference I go to, the Intercompany Long-Term Care Insurance Conference every year. And they said we need to capture all the information that's there and get it to our members or in the general public. And so they did that. So sign on to that. It's a great piece of information for you and your clients. And are there any other questions out there? That's, by the way, that wasn't part of the CE, so don't get the state on me for including this in the CE. Any other questions out there? In that case, you can all sign off. Thank you for attending, and we hope to see you in Muncie in October.